Alright, I want to go over a quick video to show you the power of selling calls when you have the stock. So you could buy TQQQ, which is up 46% I think for the year. You could just buy it and hold it and sell calls against it and make it goose the earnings. So it's at 129.15 right now. So if you look on Yahoo, it looks like the 133s are at, actually look at the 134s. I've circled the wrong one. So look at the 134s. 134s, $5 out, $4.85 out, are at 134. So 134 divided by 129.15 is about 1%. So you can get about 1%. And then if you own the stock and it goes up and it gets called from you, but you make $5, $4.85 plus $1.34, so you make $5 and $6 and whatever cents. You're going to be happy. And goosing these earnings by selling the calls, just selling the calls, let's say the stock never moves. Of course, if the stock never moves, the price of the options are going to start going down or whatever, the premium. But in this case, if you look at this, if the stock didn't move and you could do this weekly and still have a great break even, make almost 54% annually just by selling the calls, plus whatever the security makes. Occasionally it'll get called from you. You can go back and buy the security again or whatever, but sell the calls a little bit higher from where they are is what I normally do, and get that premium. Even if it gets called from you, if you do this, these are weekly options. If you do this weekly, it really can add up to be a lot of money. Now let's look at selling the puts. Now it looks like the premiums are pretty good on the puts and the calls. So let's look at the puts. So let's say you sell the puts at 125, and let's say you get $1.89, what it traded at last. So $1.89 means that the stock, to lose money, would have to go down $6.04 because it's 129.15 right now. It'd have to go down 4.48%, or else you're going to make money. Now, what's the maximum amount you can make? The maximum amount you can make is if it didn't get executed at all. So it's above 125, which it should be. You're going to get 1.51% a week in a week. So that's 78.72%. So essentially, you're making a bet that the stock's not going to go down more than $6 in a week. And for that, you make 78% annually. That's just a great risk reward for your money, and especially when these options are selling really nicely. Now, when you go to buy these, it's better to be disciplined and just let it pass if you can't get a good price on it. So I would say sell the puts, or sell the puts on down days. If you own the security, sell the calls on up days, because on up days the premiums are gonna be more, and then on down days the put premium is gonna be more. And if you sell it when it's down 2 or 3 points, if you sell the puts and then it goes right back up, you've already made money. And this happens very often, if it's just a market range. It goes down one day, it goes back up the next day, so forth. And especially for a security that's, the market's hit all-time highs, and this is up like 46% for the year. Now, what could you do? You could actually just buy the common. So, a good strategy for people that don't want to really trade that much, they could just buy the common, hold it, don't get scared, just know that the market's going to hit all-time highs next year sometime, okay? And you're going to be in the money. In the meantime, if you want to, as you own the security, sell the calls against it. But don't sell the calls at the money. If it's trading at 129.15, see where you can make $1. In this case, at 134, you can make $1.34. You can go all the way out to 135 and make $1. And so that's still a lot of money. So you kind of you can scale your risk by moving the calls or the puts that you sell, or that you that you sell, depending on where it is, how deep it is in the money or whatever. So take a look at this. I really like selling the puts. Now, when you sell a put, you should look at it like, I'm buying this security. I'm willing to buy this security at that strike for the premium that you're giving me this week. That's the way you should look at it. Now, if you do it out of the money and you're really hoping that you never get executed, then that's great. But if you're not willing to hold the security, don't sell the put. Just don't do it. Because occasionally it will be put to you, and you don't want to be one of those people that it goes down 4 points, it gets put to you, it goes down another 4 points, you sell it, you lose money. Just know that when you pick a horse that is going to come back, and even if you have to hold it a month or two, just wait for it, and then wait for it to come back, and then sell it. Now, if you sell puts and the security gets put to you, you can go turn around and sell the calls. But let's say if it goes down 4 points while you have it, then it goes down another 4 points pretty quickly. So you're down 8 points, and maybe you made some premium, so you're not down that much. So you're not down a whole $8. But, the premium for the call further out is not paying very good. So don't, if you sold the put at 130 and it went down to, now it's down to 122, don't sell the call at 125. You're happy because it got executed, but you're still losing money because now it's got called away from you. And, so in that case, sometimes you just have to wait for the security to come back. So just, hold it, know that it's going to come back. Even if it takes a couple of months to come back, next earnings season, whatever, maybe macro things that are happening in the world has made the market go down for whatever reason, or interest rates, or the Fed said something, or, it's that time of year, or, whatever happened, just wait it out. So that's what I do. All of my trades have really been winners this year because I got stuck holding for 40 days and 41 days, something like that. I got stuck twice, and I just held, and I ended up making at least 5% that month, maybe more. And so sometimes when a security like this goes down and then it comes back, it's raring to go. So we've had a good run here from like 108 to 129 in a pretty short period of time. But tech earnings are going to come out. This thing is going to run till the end of July, and then we'll have to see what happens there. The premiums might tighten up after that, so we'll see. But anyway, sell your calls if you own the security. Sell the puts if you don't. Play it close to the money to get a good premium on the put if you want to get put the stock. So that's a good way to buy the stock. If you're up and you own the security, you're up and you want to sell, instead of selling, you might think about sell the call. So let's say you own it right now and you want to sell it at 129. It's trading at 129.15. You're like, I'm out at 129. I'm gonna sell it because I made money. It's better to sell the call for $3.50 right now, and you make an extra $3.50 instead of selling it at $1.29. So that's another way. The other way is if you want to buy security, sell the put right in the money, and then you get the security cheaper. You basically bought it cheaper. So let's say you sell the put at $1.29, or let's say you sell it at $1.30 when it's trading at $1.29. You figure it's going to get put to you maybe that week, but you got a good premium. So at $1.30 right now, the put is $3.70. So, why wouldn't you do that? You're getting it $3.70 cheaper, minus the 85 cents. So you're getting it $2.90 cheaper or whatever. Anyway, think about this. So when you're going to sell, think about selling the calls close to the money and getting a big fat premium instead of just selling the security. And when you're buying, think about selling the put really close to the money to get a big fat premium. Better way to get into a position is to sell the put and get the premium, and a better way to get out of it and sell the security is sell the calls really close and get a big fat premium. This advanced ways to goose your premiums, normal people in the market just don't do this as much, but this is a way to really goose your premiums. And if you do it weekly or if you do it often, the annualized rate of return can really add up.